Hello, everyone. Thank you for joining me again today for the Dealmakers Series, where I'm interviewing some of the top deal makers in the DFW area. Today, I am joined by Jennifer Cuello. She is a partner in the Audit and Assurance Division at EisnerAmper. Jennifer, thank you so much for joining today. Give us a quick introduction of yourself and an intro on EisnerAmper.
Great. Hi, James. I'm really excited to be speaking with you today. Thank you so much for having me. So, as you mentioned, I'm an audit partner and I'm in EisnerAmper's financial services group. A little bit about EisnerAmper. We're a global audit, tax, and advisory firm with over 400 partners and 4,000 employees. We've grown considerably over the past couple of years to a really kind of thorough range of service offerings. So I have just started saying if you have a business need and we have a group that's large enough that we can either service that need or find you the right resource that will. So within that massive umbrella, I work specifically on audits of funds, all shapes and sizes, hedge funds, private equity, venture capital, fund of funds. And the range is really broad as well, ranging from maybe 10 million AUM all the way up to multi-billion-dollar fund groups. So no stranger to the emerging manager, but also handles some of our largest accounts as well. And within that, my book is pretty industry agnostic. So the funds I work with invest in a little bit of everything. In terms of my history with the firm, I've been with the firm nearly 15 years now, which is basically a lifetime in public accounting. Originally from the firm's New Jersey office, and kind of became a hybrid between New Jersey and New York before being asked to move down to Dallas to grow our Texas presence. So I've been here in Dallas, Texas since 2019. Very happy and thrilled to be part of this community. I'm also relevant. I'm the immediate past president of the Association for Corporate Growth, DFW. James, I know you're very familiar with ACG, but for those who may be listening who aren't, it's a global merger and acquisition middle market focused network with about 14,500 members globally, of which 700 are here in DFW. Just a really incredible organization to be a part of with some really amazing deal makers. So that's a little bit about me.
I didn't actually know ACG was that big, so I'm glad you dropped
Huge.
that nugget. Yeah, I didn't know it was that
Yeah.
big at all. So,
Yeah.
and are you from New Jersey?
I'm originally from New Jersey, yes.
Well, so am I. That's good.
Where in New Jersey are you from?
I'm from a little town called Piscataway.
I know Piscataway very well, actually. I'm from Randolph, which is near Morristown. I always have to kind of calibrate people to where exactly that is.
Yeah, yeah. Well, I didn't know that, so we're gonna have to chat about that
We'll
offline for
circle back.
sure.
Yeah,
Yeah,
for
yeah,
sure.
for sure. So let's get right to it. Let's talk about the state of deal flow and deal making and M&A. How would you currently describe the state of M&A that we're in right now?
Sure. So I'm going to talk a little bit more general because again, I'm an audit partner. So the things that I see and the things that I hear from my client base, my colleagues, and then other people in the market. I think the general sentiment going into 2025 is surprising because it was anticipated to be a really strong year for deal making. And I do think some of that has started to come to fruition. Obviously, a lot of positive forces generating that sentiment. So you have availability of capital and the pressure to invest that capital. So that's not anything new, but it hopefully will help to drive transaction volume. There's a significant need for exits in private equity and venture capital funds in particular. So you have these funds with all this pent up value in companies on their balance sheet, really, really great companies in many cases. And that value at this point really needs to be realized. These are limited life funds where hold periods for these investments have now extended considerably over previous years, just because the exit market has been difficult. So there's a lot of pressure pent up to exit companies in the portfolio. And it's also like kind of a chicken and egg scenario for fundraising. Exits also help fund managers raise their next fund. So some pressure there. Lower interest rates, cost of capital has declined. I think there's also a perception of a more favorable regulatory environment. And then you also have the impact of AI. It's not super extensive yet in deal making, but it is enabling buyers to optimize and narrow target lists and identify and scan for risks. So it does kind of hopefully help quicken the diligencing, and which is really important actually in this really competitive environment. Now, all that positive sentiment being said, I think some of this is definitely currently being offset by uncertainty, and I would put a double underline on uncertainty. I think over the past couple of weeks, we've seen an incredible amount of volatility as the market reacts to tariff concerns and geopolitical instability. So that kind of uncertainty can't be ignored. But I would say overall, my colleagues and friends in the deal space all seem very busy, which is very good. And you even look to something like late last week with the announcement that Pepsi was planning to buy Poppy for $1.5 billion. So notable large M&A transactions in the space. seeing both large and small getting done, like that's again a good thing for the current state of M&A.
Definitely, yeah. We like to see the the bigger deals
Mhm.
that can maybe have that impact further down on the value scale there for sure. So let's talk a little bit about value, and if you can kind of speak a little bit to strategies that you're seeing, or like the trends and strategies this year so far, and kind of maybe where your clients are finding value.
Yes. So underpinning what I was mentioning before about the need for exit, have besides traditional M&A, we have seen pressure for VC and P funds to be a little bit more creative to exit investments. Secondary transactions have kind of ruled the day for 2023 and 2024, especially. And I think that's just going to continue until there's kind of more certainty around a strong deal making 2025. So one way that some of the limited life funds I was talking about earlier solve for a tough exit market is by establishing continuation funds. Great name, just like it sounds. You as the investment manager start a new fund where investors can come in. Previous investors usually have an option to roll. So you create this new entity and hoping to continue holding an investment or group of investments for a longer period of time without the pressure of that term limit. Those, a lot of them I'm seeing done at a little bit of a discount to the last valuation. So that's something, again, that's the incentive is to reduce the pressure of the term limit, but you might have to take a little bit of a haircut on that value. And you also have situations where LP-led secondaries, where LPs are selling their interests to new investors to get some liquidity, maybe change their allocation a little bit. So that's something we're seeing at the fund level. One other thing we're seeing, and again, I can't think it kind of remains to be seen how big this is going to be, but we've seen some of our clients and others in the market participate in these take private transactions. Also a really good name for something. It's just like it sounds. Some companies that are either showing signs of struggle after years of being public, or companies that went public during the really rich valuation years of 2021 and 2022, who've kind of fallen off those highs a little bit, are now being taken private by private equity. And I think one recent example of a long-standing public company that's gone private is Walgreens. That company was a public company since 1927, and Sycamore Partners is participating in taking them private. The other thing I think that's interesting about that, deals like that and of that size can also be opportunities for banks and private credit, which many times compete to kind of work together. So that's just another thing that's a little bit interesting in the current market.
Yeah, so I've heard too a lot about less platform investments, more
Yes.
add-ons in the last few years. So I think you're kind of confirming that as well.
Mm-hmm.
So what about, let's kind of shift gears a little bit here. What about how would you describe the current climate with interest rates now looking like they're going to be paused for a little while? I know at the time of this particular interview, we have a rate decision coming up. We know the rates are probably going to be held.
Mm-hmm.
I think that's fairly safe to assume. But what's this climate like for your clients, for business, as well as how the tariff situation is impacting deals?
Sure. So again, the tariff situation, and I think that hand in hand with the geopolitical uncertainty, that's causing a lot of market movement, and we're kind of a little bit destabilized, I would say, and that destabilization factor, I think, is one of the reasons why everybody expects the Fed not to move rates, because they don't want to be seen as being overly responsive to something that they think is maybe a temporary state. So I think, all things considered, I think, again, lots of volatility may be a stabilizing factor. So I actually don't necessarily know if you'll see the impact of the interest rate staying the same impact anything for deals at the current moment. I think obviously if you look at it comparative to previous years, as the interest rates have come down, it creates, what we hope is going to be a more favorable environment for deal making, and it's kind of taken those costs down. All in all, I would say tariffs, geopolitical uncertainty, taking things a little bit all over the place right now, probably disrupting deal flow. The interest rate staying the same, probably a neutralizing factor. And again, that's just kind of my 2 cents of what I would expect.
Yeah. I know a lot of folks were hoping that 2025 was going to be a lot more movement, a lot less wait and see like it has been the last couple of years. But it seems that's what we're going to get another helping of this year. unfortunately, at
Yeah.
least for the first half.
I hope not. I hope I really hope that a lot of this comes to fruition maybe a little bit later than we thought it would. But as I mentioned before, a lot of my friends in the deal space are talking about staying incredibly busy in the current environment. I just am concerned that with some of the instability that some of the deals that are in process go on pause versus getting to closure. So that would be, I guess, my general concern with kind of the state of where we are right now.
Yep, yep. And so you're coming from the audit side of things. Talk to us a little bit about the carried interest and the impact around deals there. How's that kind of entering the conversations?
Sure. Examining carried interest a little further, right? So, because there's two very distinct views and opinions on carried interest, which is what's creating all this talk around it right now. So, carried interest is not a guaranteed amount. So, in most private equity or venture capital waterfalls, the limited partners have to first get their money back, then many times get a preferred return, which in many cases somewhere between 8 to 10% before the GP starts to even earn that profit. So while they get a management fee, the carried interest is not guaranteed. And I think it's what's viewed as kind of like their sweat equity for holding on, diligencing deals, getting to the portfolio. So one thing I wanted to just get across is that it's at risk. It's definitely not a guaranteed amount. The second is that carried interest incentivizes fund formation, investment in businesses, and entrepreneurship. So those are all kind of, if you are a supporter of funds and the carried interest model, like those are all the positives that kind of come along with carried interest. The controversy surrounding this is how the carried interest is taxed. So right now, carried interest is taxed at a preferable rate, 20% capital gains tax, versus some others who view that it should be taxed at the ordinary income rates as high as 37%. So first and foremost, I want to say this is not a new argument. So the last 3 presidents have said they're going to work to get rid of this discrepancy and effectively tax the carried interest at a higher rate. And the last major change was the Tax Cuts and Job Act enacted by President Trump in his first term, which what that did at the time was it changed the time that funds needed to hold investments from 1 year to 3 years in order to get the preferential tax treatment. But since then, there have been numerous provisions and bills brought forth since then favoring the higher tax rate. So, what's the deal today as we sit here now, and what's the potential impact on deal making? So about a month ago, the president brought up his intention again, like solidifying his position that he wanted to end what he considered to be a carried interest loophole. But the real question is, how serious is he about it with all the other things that he has on the agenda, and whether he can get it done in this new administration. And obviously, those in the fund ecosystem want to be prepared. So they're already kind of rallying hard, bracing for what could be a fight if they need to. But it all does really remain to be unseen. So I would say, I talked about the double underline of uncertainty. This is another area for that as well. But let's say something did change here, and, whether it be that the rate increases or that the hold period gets further extended to 5 years or something. So if GP after tax returns are being reduced, it's going to weaken some of the incentive that comes with launching a fund. I would anticipate it could lead to GPs wanting different terms, not only from their limited partners, but also from their portfolio companies. So I think, nothing is being done right now as it currently stands, because right now the rate is 20%. But I think you have to anticipate that both funds and their terms and, portfolio companies and the deal space can be impacted by something like this.
Very convoluted, it sounds like.
Yes, for sure.
So hopefully we'll get to see how that shakes out later in the year,
Mm-hmm.
and maybe get a little less uncertainty going and more deal flow.
Yes.
So, all right, let's wrap up a little bit with some perspective around DFW and Texas. Mm-hmm. What makes the DFW market unique versus all the others, or the Texas market versus other states?
Sure. So there is no secret, no surprise. Everywhere you look, Texas is the hot spot for business relocations. That is small businesses, large corporations alike. I mean, I think we have to be pretty special if even Kentucky Fried Chicken is moving its corporate headquarters from Kentucky to Texas.
Yeah, that's pretty, yes, I didn't know that. Wow.
Yeah, there's got to be something special there, right? A lot of that underpinning the pro-business tax and regulatory environment. Our central location in the U.S. doesn't hurt. Growing population. We have the Texas Stock Exchange coming here. Personally, Universal Kids Resort in Frisco opening in 2026. And, we're also a leader in AI, aerospace, energy. So I think, it's some of that's a circular reference. So some factors I just mentioned kind of churn the others. And I think that churning has just continued to grow and support the ecosystem throughout the past couple of years. And I think that's just going to continue into 2025. I'm really excited to see what Texas is able to do. And on a personal level, the relationship-oriented deal environment here, I think is something very special. It's not necessarily something I can put a stat on with you or anything like that, but when people are doing deals in this market, they want to know the companies and the teams involved on a deeper level than just getting the deals done, which I think is really, really great for business. And I think it helps to promote our atmosphere here in Texas.
Yeah, I would agree as well. Everyone I've spoken with too echoes that same sentiment about the relationships and how much of a factor that really is. I think that 1,000%, like you said, I think it's very vital to getting deals done and actually knowing who's the counterparty and actually knowing them, though. I think is very, very important. And I think it makes for a much better business climate and environment for deal making for sure. Jennifer, I appreciate your insights. They were fantastic. Thank you so much for spending some time with me today. For those watching, I hope you found this useful. You can find more of these interviews on my website at jamessaki.marketing and the Dealmakers Series exclusively on my YouTube channel. Thank you for tuning in.
Thank you, James.